Hey guys, just wanted to point out a chart that I just noticed made a big move that I think all of you are going to want to know about. Let me get my big head out of the way. Actually, let me go down here. Let's do that. Yeah, that'll be good. This is the Shiller Pe ratio, or the CAPE ratio. And let me go down here. It goes all the way back to 1880. In fact, I'll just do this like I do on my whiteboard videos. Starts off at 1880, goes all the way to 2020. On the left, it goes from a PE ratio of 0 up to 45. And I saw today, and I don't know when it made this change, but it's kind of eclipsed the high it made back in, let's call it 2018, went down, and then it's come back up to an even higher level at 34.66. The only time in history it's been higher was in the dot-com bubble back in the late 1990s, where you can see down here it got up to a 44.19. Then we look at this is interesting. So most people don't know this, but the United States went through a Great Depression that no one ever talks about in 1920-21. Jim Grant wrote about this in a book, I believe, called The Forgotten Depression. And if you look at the statistics as far as the rate of unemployment, how far GDP went down, you see that initially it was just as bad, if not worse, than the first stages of the Great Depression we had in the 1930s. Don't want to get off on a tangent here, but I just want to point out that the big difference between those two depressions was, one is that the government did nothing. Zero. In fact, I think the central bank actually raised interest rates. And actually, they did do something. They decreased government spending. And in the next depression that we had in the 1930s, the government did the complete opposite. So I haven't read Jim Grant's book. I've got a huge amount of respect for him. He's definitely one of my favorites. So I would assume that it's extremely well researched. But just want to plant that seed and point out that the Great Depression wasn't the only depression of that time frame. And we had two of them that were just as brutal up front, but drastically different results. And I don't know if it's causation or just correlation, but in one, the government was not involved at all. And other, the government got more involved than they had ever been in the U.S. economy at any point in the history of the United States. So, okay, back on topic. So the CAPE ratio now 34.6, and we see that it has exceeded what the level was in Black Tuesday when we had the huge stock market crash, which kind of kicked off the Great Depression. So what this means from a simple standpoint, when I see a chart like this, whether it's commodities or PE ratio, I try to find a historic trend line. So we can say that the historic trend line is eyeballing it right around 15. So at a 15, and I would concede that this assumes that the interest rates are normal. Right? Let's say Fed funds at 5%, 6%, something like that. And that would be kind of where that trend line, that historic trend line would be. Interestingly enough, look at how the market bottomed out in 2009, right at its historic trend line. And for those of you who might not have seen a lot of my real estate videos, I point out that the real estate market went down from 2006 to 2012, and it also bottomed out where on its historic trend line. So there might be something to that. So I would argue that anything above 15 and you're getting expensive or in the no bueno zone, and anything below 15 is getting cheaper. So I really want to be a buyer in the early 1980s. And I'm just talking about the broad stock market. Of course, this doesn't apply to individual stocks. There's some stocks right now, like commodity producers, that I think would be cheap, but I'm just talking about the broad S&P. So early 80s, a buyer. Early 1930s, a buyer. Early 1920s, definitely a buyer. And potentially even a buyer here when you take in consideration the amount of money supply that's been increased when it gets down to its historic trend line. Now, I know that we've increased the money supply dramatically since it hit that bottom in 2008, but I think they are still cheap. If you want to argue that the money supply is increased, I would say, well, that money supply isn't translating into the P&L of the corporations themselves, or this number would be a lot lower. So even though there is a lot more money supply, maybe chasing fewer amounts of stocks, I would say that fundamentally it's still not justified, because again, if the money creation was trickling down, let's say, to the profit and loss of the business, then this multiple would go down. So I really wanted to just point that out, because if you're in the stock market now and like a 401k and IRA, you need to be cognizant of the fact that the stock market is expensive, almost to the point where it's, well, not almost, but it's expensive to the point where it's only been this expensive one time before. And that was when we had the dot-com bust, and we know what happened then. So if you look at the risk reward, I think that's the main takeaway for this video. It's just terrible. It's very poor when you look at the overall S&P 500. So what do? I'm going to address that in the next video that I do today. So stay tuned, and we'll see you on that next video.